I think FTX is the really interesting one there because it was the first time that the TradFi world really properly accepted and bought into the DeFi world and the Web3 world, and it ended pretty badly, obviously. And it shows the same problems of traditional finance can creep in: the information
Hmm.
asymmetry, the kind of underhanded operations of the companies in
Hmm.
Web3 in some cases. So, but it also shows that the demand was there. Welcome to another episode of the Untangling Web3 podcast. Alec, how are you doing today, mate?
I am very good. I'm very good. It's very dark these days, so I've got nothing better to do than be recording podcasts with you, Jack. How are you?
Yeah, not too bad, thanks, mate. I'm all good. Yeah, so today we are we're kind of going on an interesting journey, I think, because you and I have both for quite a while been excited to talk about this concept of DeFi or decentralized finance. And then we started planning an episode for this to talk about it, and we realized actually we might have to spend some time talking about TradFi first, right? Traditional finance or CFI, centralized finance, whatever you want to call it, just the old financial world, because so much of what DeFi is doing is building on or modifying concepts from existing finance. So, yeah, I think we're going to be on a kind of multi-episode arc here, right, where we talk about TradFi to build us up to understanding DeFi a little bit more.
Well, yeah, I mean, I think for context, I just want to say this is a very complicated topic, right? It's like
Mm.
we planned to do this a while ago, and we're like, you know what, we'll just record it next week. That'll be fine. And then you start looking into it. You start looking into all the different episodes out there, all the different books out there, all the different articles and newsletters, and it is complicated. There are so many different angles to this. You kind of just think of traditional finance as just being banks and loans and super simple, and Bitcoin's going to replace everything and all this kind of stuff. But it's so multifaceted. It's so complex, and I think it's really important for us to deep dive, like you said, into traditional finance specifically to understand what's going on right now, because it's so much more than just banking and removing some intermediaries, right? When we talk about the opportunities of DeFi, there's just, yeah, it's really, really
Mhm.
monolithic in a lot of ways. And I think this is going to be quite interesting. I learned a lot in the research for this, and I'm sure we're both going to learn a lot more as we kind of go into this episode.
Yeah, I don't know about you, Alec. I feel like I've done the learning in reverse here. I feel like I knew a lot more about DeFi than I did the traditional financial world. And then in preparation for this, I've actually understood a lot more about the old world. So yeah, why don't we start from the beginning then and try and basically give a very quick overview of traditional finance and also of decentralized finance as a starting point. And then maybe let's just drill down to some specific concepts after that.
Yeah, I mean, that makes sense. When most people think of traditional financial institutes and players and actors, they think of banks, right? You know, retail banks, whatever it is, you know, Santander, HSBC. That's how most people, I'd say most normal people like you or I, interact with the TradFi world. And, you know, banks are big business, obviously worth something like 5 trillion is, and then not to be kind of misunderstood as central banks. Here we're talking about, I guess, private banks, normal banks, like the day-to-day commercial banks that we're speaking of. We had a whole episode on central banks, which are different.
Yeah, exactly, and not just banks as well, but obviously we touched on in the BlackRock episode. We talked a lot about BlackRock as another player in traditional finance, your kind of investment management firms, and the other players involved in traditional finance. But kind of my understanding at a very high level is, traditional finance is about anything you need to do with money, whether that's saving it or investing it, growing it. I mean, the vast majority of finance tends to be about growing your money, beyond the basic case of securing and storing and saving your money in whatever form it is. Most of finance is really geared towards making profit, and how do you make your capital work for you. That's basically what how people tend to describe it. And capital obviously meaning just basically the money you have as an individual or a company. You want to grow it using the range of different asset classes, different financial products, which we'll get into. That for me is just what the traditional finance world is.
Yeah, and I completely agree. And when like most people think of traditional finance, they think of like fat, lazy monopolies, right? And we said that this, you know, the point of this is to gear ourselves up to DeFi and what the opportunities are there. And when people think of TradFi, they think of high fees, slow transactions, limited accessibility, all these kind of lack of transparency things, financial crashes, all this stuff. And this is the opportunity that is presented to DeFi. And like you say, we are going to dial into it a lot more. But the philosophy of DeFi in relation to TradFi is shifting the kind of the emphasis or the focus, the need from centralized entities like banks, like the one you just mentioned, to technology and technologically driven solutions. And the foundation of that is all the technology we're going to speak about: blockchain technology, smart contracts, crowdfunding, all this stuff. And this is big business. I think it's really important to understand, like setting the tone here, that DeFi is worth around 80 billion right now, and it's forecasted to be absolutely huge over the next 5 to 10 years. But yeah, back to banks. Like you said, banks at the absolute basic level, the idea is to take in funds, and I think they call it deposits, which is effectively people's money, and pull them together and lend that money to people who need funds. So banks are the definition of an intermediary between depositors and borrowers, and that's one of the primary kind of, I guess, defining characteristics of banks.
Yeah, exactly. And when you or I, as a kind of normal retail consumer of banking products or banking services, that's our relationship with them. You tend to deposit money, and you might typically have an interest rate on the money you store there. Well, how do they generate that interest rate? That's by going and reinvesting your money in other enterprises. That's when there's kind of the front office where they're dealing with you as a customer, and they take in your money effectively as a service to give you returns. But then how they generate those returns is a whole other world, right? And that's where you get into the more kind of complex parts of the financial world, which involve the other institutions, in the background. Like I said, your investment funds, your exchanges for exchanging assets, that kind of thing. But yeah, the banks are basically, I would say, our interface for most people into finance.
And let's not throw too much crap at banks. Like everyone, we're kind of describing them as these lazy, monolithic, super slow, sluggish players, but they are shifting towards, digitalization, technology, all this kind of stuff. I think one of the stats I saw was that 3.6 billion people would be using some form of digital banking by 2024. And this is, I think that's like a big opportunity. And more we're seeing banks partnering with fintech. And don't even get me started on what fintech is. I thought fintech was some crazy advanced technology until one of my friends who works in fintech was like, "Oh no, I just do online banking apps." I'm like, "Oh, okay, that's what fintech is." But yeah, so the stat is that 81% of traditional banks are now partnering with fintech companies to actually push this, digitalization, digital transformation agenda.
Yeah, exactly. And banks, as you said, are starting to look more like tech companies or fintech companies. They were called challenger banks. I don't think they are so much anymore. Like your Starling and Monzo in the UK. I think Starling's been voted the best British bank for the last kind of few years. So these banks are becoming more modernized, and how they offer their products to consumers is looking a little bit more like the Web3 world, to be honest. And the line is blurring. You have banks also offering Web3 products, which we'll kind of come on to. But yeah, they're the kind of major player for consumers, kind of storing their money and hoping for a return and that kind of thing. Then the other major player, as you said, was kind of your stock markets and exchanges, right? So that's where maybe you want to kind of do something more interesting. You want to be more active in your how you get returns, and you don't want to be kind of passively generating income on top of your savings through a bank. Then you go to a stock market. You'd start trying to make these bets on company stocks and things, right?
Yeah, exactly. That's the big number two kind of actor in the ecosystem here. We've got stock market exchanges. They're just like public marketplaces, like Facebook marketplaces, if you will, where companies can raise money by selling shares. Investors can buy and sell those shares. And I guess that the stock markets and exchanges help in setting the prices for these shares based on demand and supply. I guess we're going to say the terms demand and supply over and over again during this. They provide a way for investors to easily convert their shares into cash, and they're weirdly quite a good indicator of the economy's health, apparently. And additionally, I guess they ensure the companies follow certain rules and standards, promoting fair play and transparency. And this is a big thing around, traditional versus DeFi, is the idea of, standards, rules, how you ensure that assets or companies on these exchanges actually do play ball properly and actually aren't doing illegal, illicit things. And this is very relevant with a lot of the things that's been happening lately with FTX and Binance. I think we'll talk about this a bit later, but that's a very important aspect of these as well.
Yeah, I think that's the key. As you said, access to consumers. Whether that be retail consumers like you or I, or companies wanting to diversify on their balance sheet what other companies they hold stocks in. Your stock markets and stock exchanges are the kind of the access point for you, and they are generally heavily regulated. So the big examples of stock exchanges, you've got New York Stock Exchange, London Stock Exchange, the Nasdaq, Shanghai Stock Exchange. These are all kind of very well known. Even if you've never invested directly on a stock exchange, you'll still know those names. There are whole news channels dedicated to the movements on them, and they're all subject to heavy regulation, and not just the exchanges themselves, but as you said, companies who want to be listed, and as we call it, as a public company, if you can be bought and sold, have your shares bought and sold by the public, there are very stringent listing requirements. And I just want to call out one kind of nice little segue into the Web3 world is with something like Coinbase. The detail they had to go through, because that was probably the biggest marquee listing we've had so far of a Web3 company on a traditional stock exchange. To get listed, they had to put in all sorts of declarations and risks and things. And one of the risks are you aware of this one, Alec? The risk they put in, which is really kind of funny to me.
What is it? So
they put in as one of the big disclosures, a huge risk would be if the identity of Satoshi Nakamoto is revealed, right?
Really?
If Satoshi comes back, then that's one of the things they identified as their major risk. So even they had to put that in the listing.
I mean, there's layers to that. I mean, it's like Inception kind of complexity. It's like Coinbase is an exchange. Is it a Web 2 or a Web 3 exchange? Debatable. It's kind of like this Web 2.5 where it gives you access to Web 3 assets, but it does it in a very centralized Web 2 way. And that exchange is listed on an exchange. It's like to be listed, you have to hit all these regulatory standards that Coinbase itself doesn't really implement. And it just like blows my mind a little bit.
Yeah, it's an interesting world. And you also have kind of lots of other different types of exchange. As you said, Coinbase itself is, I think we'll get onto the types of asset, but that's more of like an alternative assets exchange, right? Because they deal primarily in crypto assets, like we've covered in the past, like Bitcoin and tokens on top. You also then have stock exchanges, alternative exchanges like Web3, and then derivatives exchanges. So trading contracts to go one level deeper into the Inception analogy. Trading contracts about assets. And that's the kind of thing that, the Chicago Mercantile Exchange, CME, would deal in, for example. So, it's as soon as you go below the surface level, you start thinking, oh my God, there are all these different strange variations on trading.
It's ridiculous. Like having debts and then betting on debts and then debts betting on debts. Like it's ridiculous. It's like just terminology for the sake of terminology and complexity for the sake of complexity. I think, one of the interesting things about the stock market generally in like say the last decade or so is that it's experienced growth, like much more. I mean, it's always growth, right? But the economy is always growth. That's the point of capitalism. But it's much more growth than it has been previously, and much more volatility because they've opened it up to standard retail participation, which is normal everyday users like you or I, who may be a bit more kind of fickle with our investments or a bit more risk averse potentially. I see something in the news saying Donald Trump's been elected or something like this. I'm like, well, get all my stocks out quickly because I'm scared the economy is going to tank or whatever it is. So that's an interesting thing, is there's more volatility in stock markets generally. And another one is all these IPOs we're seeing, like lots of tech IPOs, like they're the biggest news all the time. Like obviously Coinbase's IPO was an absolute fiasco, like big money everywhere. And exchanges are facing bigger and bigger regulations for new listings because of, market manipulation, all these things. It's not just, say, the DeFi sectors that are coming under, say, more regulatory scrutiny, but it's also TradFi because of all these, probably mostly because of all these tech companies that are listing.
Yeah, and maybe we should just say IPO. We've both used the term now. It means kind of initial public offering, to the first time your stocks are floated on a public stock exchange. I actually heard the term ICO before I ever heard IPO, which is the kind of Web3 equivalent and much more maligned, the initial coin offering, where I don't know if I don't want to spoil, I won't spoil it actually. There's a TV show about technology that used this in quite a funny way. But essentially companies in the past, and still to an extent do now, have tried to raise funds against tokens of a new blockchain, for example. that they're issuing, and they actually, instead of issuing shares in the company, they're issuing a share of, or a number of tokens, right? And that's a whole nother world. That's very much alternative assets. That's not as nowhere near as heavily regulated right now. But yeah, it's just worth mentioning. You still have these analogs already creeping in between TradFi and DeFi.
Yeah. So that's the first two big actors that we've spoken about: banks and stock markets/exchanges. And the third one, which is another really big one, is investment and asset management firms. And I mean, these are companies that effectively handle money for individuals and organizations, probably using stock markets and exchanges, as we've just spoken about. But these, in my mind, are the definition of middlemen in a lot of ways. Like the aim of them is to, grow people's money by investing it in stocks and real estate. So they tend to do it on behalf of their clients, tend to be experts in the field. And, I give £10 to whoever it is, a JP Morgan of the world or something like this, and they promise to give me 1% return, and they make a little margin on that. But these are big players that handle. It's not like small companies. They are trillion-dollar companies or multi-billion-dollar companies a lot of the time.
Yeah, and it's very big business. Obviously, it's where you make the most money. If you've got a maths degree or a science degree, that's where you want to end up, because that's where all the money is, right? Because you have these huge teams of people, and this is what you'll often see much maligned in media and films and stuff, is you have these people at these trading desks and building trading strategies, right? So how do I best, I think they call it alpha, is alpha is your improvement on the general market. How do you get more returns than the average person who puts their money into the S&P 500, right? And it's a highly specialized thing, and it's also becoming much more automated and actually much more AI led now. We mentioned in a previous episode someone who moved their entire investment management firm to using artificial intelligence and algorithmically trading assets. So it's a huge business, and you will have heard of a lot of the names. Like as we said, BlackRock is the biggest asset management firm in the world. You also have like your Vanguard. You see them advertising all the time on TV as like a consumer focused asset management firm. And then you also have things like your pension funds. So wherever your pension is going every month, say something like an Aviva, they're effectively managing those funds for you until you retire, trying to reinvest those funds as well as possible to make sure you have more when you retire than you put in.
Yeah. And I think, like you say, it's big business, this kind of stuff. Like I kind of have maybe thrown them off as middlemen, and they don't add much value. But it will be really interesting to see, like you said, what happens to these businesses when AI becomes the norm and there's like open source models that are just like the optimum way to get returns on investment. Like, because is it like a net sum game, like zero sum game type thing, where it's like, if everyone's doing the optimum strategy all the time, how can anyone make money on this? Like, will it just defeat the idea of these investment firms if there's just an open source protocol that is the optimum investment strategy? You no longer have people competing against people. This is an interesting kind of topic, but maybe one that's slightly outside the remit of this talk.
Yeah, well, I think it's important though as well, because you're saying open source, but these companies, the strategies they build are highly secretive. They're obviously like they're the main IP, arguably, that these investment management firms have, is the strategies they're using. They don't make them public for obvious reasons. And there's kind of a difference there between in the Web3 world, where we have more transparent, open protocols, but you still do have people trying to make a buck. You have traditional investment management firms trying to make a buck off alternative assets like Web3. Digital assets. So yeah, there's a bit of a blur there between the two worlds. Speaking of asset classes, I think we've thrown around a couple of them so far. We should probably define them a bit better before we go any deeper, right? So there's kind of 4 or 5 that we should probably cover. There are like hundreds of asset classes, but I think if we just hone in on a few, that should give us a decent grounding, I think.
Now we're getting to the real meat of the episode. This is the really exciting stuff for everyone at home. Yeah, sure. Let's jump into this. So I think the big one, well, one of the big ones, I guess, probably one of the more complicated ones as well, is securities. So securities are financial investments like stocks and bonds, where you're essentially buying a small piece of a company or lending money to someone in exchange for interest. And really importantly, they're not physical things. They just represent a financial agreement. Like, to kind of keep it layman, which always helps with me, is that they're like tickets that you buy that can either represent, a tiny piece of a company or a small loan that you would give to someone.
Yeah, exactly. And it is quite an abstract definition. I always find myself fumbling around when I think of, what is a security, but it is very broad, and there's lots of different subdivisions of it, which we won't kind of go into too much detail. But again, one of the important things is that securities are highly regulated. So, because they're so abstract, and as you said, they're talking about taking a small piece of a company or taking a loan from in a government bond or something. They are very, very heavily regulated. We've mentioned the Securities and Exchange Commission of America. And there is a very, very broad definition they use, which is another link back to Web3 that I'll bring in. But the way you classify a security normally is something called the Harry test, right? And they basically say, if this asset or contract or whatever the financial thing is, the financial product, if it is an investment of money, well, that's basically all of them, in a common enterprise, so something that has a common goal, like a company, for example, with an expectation of return. Well, as we've said, you're always expecting a return when you put money in these things. And then there's actions on a third party to generate those returns. Then it's classified as a security. And there's been a lot of debate playing out, as we've seen recently in the media, with the SEC and Coinbase and other crypto projects like Ripple, about the definition of digital assets and Web3 assets. Are they securities or not? Because it looks like a lot of them could be satisfying those 4 criteria, but it's not completely clear.
And I guess the important thing around like why actually people care about this is mostly because of the regulation you come under. If you are a security, it's a bit more stringent, like you just said, but also the tax around that, right? If something's classified as a security, then you're more heavily taxed versus other asset classes. And I think one of the main arguments from my understanding was around, whether things like Ethereum are securities, and it all came down to, was it due to the actions of a third party / the common enterprise one? It's like, are there people that can manipulate this asset class, for example? And they said Ethereum, that actually is the case. Like, people do control the agenda and how it works and things like this. Whereas Bitcoin, it seemed to be that they inferred, the SEC inferred, that it's much more open than that, and it's really difficult. There's no one market manipulator. It's very hard for them to do that, so it actually doesn't classify as a security. Is that correct?
I believe so far, but who knows what will change in the future if the definitions will shift. And actually, that's one of the reasons I mentioned the ICOs before as well, because that's one of the reasons lots of companies that did offer these ICOs actually ended up violating these securities laws, because they were selling tokens in expectation of profit of that company or that blockchain protocol, working to make them a return, right? So they effectively were unregistered securities because they didn't register with the SEC. So we've seen lots of examples of people falling afoul of that definition already. But yeah, we could talk for an hour about securities, but that's the kind of the high level.
Please don't talk for an hour about securities. So like you say, that's securities done and dusted to an extent. The next one, much more easy to understand, the one that I get personally, commodities. These are just physical goods like oil, gold, wheat. When you invest in commodities, you're investing in actual products that have a tangible presence, right? They can be bought or sold in markets, for example. And I think they're often used by, who's invested in wheat, for example. That's a question I asked. They're often invested or used by investors to protect against inflation or market fluctuations, right? As their value isn't really as kind of moves differently to, say, stocks and bonds, for example. You always need wheat. It's pretty stable.
Yeah, and you're right. I think especially in the precious metals or things like gold, silver, platinum, uranium, I've also heard, as an example of what kind of these commodities that are potentially highly lucrative, but also, the gold, platinum, silver, very stable in value, seen as a good hedge against inflation, and things like that. And one interesting thing about commodities is that, you think of them as physical assets, but even they can be traded in kind of non-standard ways. So you can either buy them directly, OTC, they call it, over the counter. So you basically have actual marketplaces for this, go into a physical market to buy them. Or, and I think is more commonly done now by lots of these financial management companies, is you'll buy what's called futures contracts or derivatives, and derivatives we'll come on to, but kind of these are contracts based on that underlying value, right, of the asset that's been in motion. And we mentioned the CME, Chicago Mercantile Exchange. That's the kind of place you can go to buy and sell through these contracts. But I've heard, people doing this with like the price of oil barrels while they're in transit from the source to the destination place, right? This is crazy to me. People buy and sell contracts for the oil barrels while they're in transit, because you'll have all these different risks associated, and the price can change a lot while they're on the boat. So it's fascinating, but a little bit scary to me.
It's ridiculous. Can nothing be simple? Like, you try and define a commodity as something you can use, and then people are betting on the future value versus the debt associated with it. Like, why is financial services, why is TradFi so complex? I think unfortunately, it's kind of important for us to understand, because these are the opportunities that DeFi presents in reducing that complexity, adding to the transparency and preventing, some of the issues we'll talk about a bit later that have come about because of the complexity that's involved in this kind of stuff.
Yeah, exactly. And I think we'll come on to some kind of issues with DeFi as well, because whenever you're talking about things like commodities, you have physical, tangible goods, then you have the question, how do you actually connect those to the digital world? And things get a lot more complex.
One thing I want to say on this kind of gets my grinds my gears, is around gold and the intrinsic value that people say, oh yeah, well, what's it called? Bitcoin's never going to replace the gold standard because gold has an intrinsic value and Bitcoin doesn't have an intrinsic value. And yeah, gold is used as a precious metal in like semiconductors sometimes and engines and all this kind of stuff. But really, it's like a cultural kind of association and prioritization of gold that's just come about over thousands of years. And this intrinsic value is actually kind of, I guess, quite cultural. It's kind of been put on it. And that really the intrinsic value is actually kind of maybe more metaphorical and ephemeral and all this kind of stuff.
I was going to say, that's a good point from the Peter Griffin School of Economics there.
Exactly. And I think my point here is that it's actually not too, and I'm not sure that Bitcoin should replace the gold standard. That's not really what it was intended for, right? It was this peer-to-peer digital cash system. But I don't think it's too big a leap for Bitcoin to actually, be this potential holder value that would replace gold for a lot of the reasons we've spoken about previously. And this kind of intrinsic value that people hold gold up because of is really just something that's been around for thousands of years, that people trust in it and think it's never going to change, right?
Yeah, exactly. And, there's a famous kind of joke, but it's true. If a meteorite crashed to Earth that was full of gold, then our trust in the value of gold and would completely dissipate overnight. So it's not completely faultless. And I agree with your kind of idea, right, that Bitcoin could fulfill a lot of these properties. And that is also why, as we said, BlackRock is looking at the ETF, because it's starting to be treated like all these other kind of traditional financial products as well.
Okay, so big number 3, cash. We've done a whole episode on cash and digital cash. So if you don't know what cash is, I recommend go listening to that episode.
Yeah,
it's actually a nice throwback.
Yeah, exactly. And, you have different forms of cash. You have things like cash equivalents, essentially just liquid assets you can convert into cash. But I think a very uninteresting thing for us to talk about. So maybe we'll just skip over that one.
Yeah, exactly. So I think number 4 is a bit more interesting. Well, not more interesting, but kind of it's maybe easy to understand initially. Real estate. Like real estate investment is simple to understand. When it's direct ownership, I own my house. That's an investment. That's an asset, right? I think actually one of the things I did want to talk about on this is the financialization, if that's a word, of real estate, particularly through mortgage-backed securities. And now we're starting to have overlap between the different asset classes and some of the complexities you mentioned earlier. And this, mortgage-backed securities introduced layers of complexity and risk. And for anyone that was around for the financial crash in 2008, as depicted in The Big Short, which I would highly recommend. They'll explain it much better than I ever could. I mean, this is one of the complexity and the risks that I'm about to talk about is actually one of the reasons that led to the financial crash of 2008. And, effectively what happened was home mortgages were bundled together and sold as securities, financial products to investors. And the problem was that the lack of transparency and really understanding of these bundles and actually the risk of the bundles being much higher and the quality being much lower of the debt that was associated with these bundles created a lot of confusion. And owning a security like these mortgage bundles is kind of like owning a financial paper that represents a mortgage payment. And it was actually really far removed from the realities of the housing market. And this complex financial engineering really led to a disconnect between reality and the financial state, and the lack of transparency really played like a massive role in the financial crash of 2008. And the reason I talk about this is because, again, this is another huge opportunity for DeFi generally to create, more transparency, more understanding, and hopefully remove some of the complexity that's involved in these crazy things like mortgage-backed securities that I hate the idea of.
Yeah, I think I would also recommend going to watch The Big Short, because it shows you how the complexity of building assets on assets and derivatives of derivatives can be quite dangerous, especially when you have this kind of information asymmetry. You have these private asset managers all trying to make that alpha on the underlying assets. And I think, yeah, that shows part of what we're striving towards in the DeFi world, is to have more transparency over these protocols. There's a kind of analog of this called composability in Web3, where you build things on top of each other, but you actually can see the underlying protocols for all of them at the same time. So we'll definitely come back to that one. But the other part I'd like to mention there is, with the Big Short and what happened in the big financial crash of 2008, is that you saw some of these big players like the Lehman Brothers, going under, which were trusted, effectively, financial advisors and asset managers. So it shows that things can go wrong. And when they go wrong in the TradFi world, they tend to go very, very wrong. And it ends up being the consumers holding the bag. And I don't think that's completely solved by any means in the DeFi world, especially not now, maybe in the future. But yeah, it shows that there are problems to be solved. There is a good motivation for moving to the DeFi model of things, I think.
Yeah, I'm glad you mentioned that, the information asymmetry, because in the Big Short specifically, they really highlight that big players like Goldman Sachs knew that it was coming, and they knew the financial crash was about to happen. And what they did was they put it off to everyday consumers like you or I to say, okay, we actually know this is going to happen, mostly because we've caused it to happen. But now we see it, we're going to give it to other people, give it to everyday users, and let them pay the burden of the financial crash that we have in part caused. And I think, yeah, I'm not saying blockchain's the answer, but I think the principles and philosophy of DeFi actually should really combat that in a lot of cases, hopefully.
Yeah, exactly. It definitely shows that the system can be improved, right? And that kind of does bring us on to the last major classification I mentioned earlier as well, alternative investments. This is, a lot of these things are, there are traditional alternative investments. So like things like what hedge funds do, and private equity firms taking a large majority stake in a company, improving it, that kind of thing. But also things like art, collectibles, anything that's not a standard kind of form of investment, along the lines of the other categories we mentioned, comes under this alternative investment. And they have a very different risk reward profile. There are very different risks associated with acquiring a company, trying to improve it, or owning art and collectibles. But this also encompasses, your crypto assets, which again, as we know, have a very different risk reward profile to traditional assets, which are, we have the high volatility. You have existential risk. You don't know if this blockchain will be here in 10 years, for example. And you also have your digital art, your digital collectibles now with your NFTs. So they're all kind of bundled into this new asset class.
Yeah, and like you say, much less regulated, which means the risk return profile is very different to traditional assets. Probably less accessible to, like you say, normal people. Like, it tends to be rich investors that buy collectibles and art. And I think we're already seeing the opportunities here with DeFi as well, with the NFT craze of Bored Apes and all this kind of stuff that we've talked about many times on this podcast. But collectibles is no laughing matter. Like, collectibles generally, the market is huge. We had Sean come on a couple of weeks ago now, and talking about access rights and management of assets, and it is huge. The collectibles market, like, I was shocked to hear how big it is and how important it is, and how it's like kind of so intrinsic to humans to really want to own things and collect as many as possible. I don't know what it is. It's like the inner grok in me, the inner ug in me, wanting to just have a collection of berries or whatever it is. But people love this stuff, and it's a huge market. It's a huge opportunity. And I think NFTs, I know we give them a lot of crap, but there is value to be had there for collectibles, especially with some of the utility things that we've talked about, I think, previously in episode number 3.
Yeah, I don't know about you. I've still got my some of my very rare Yu-Gi-Oh cards in a shoebox
Oh,
somewhere.
yeah.
So you never know. Yeah. But I think it's important that you mentioned that, so I think alternative investments are things that have traditionally been much less accessible to the masses. But that, as you said, part of the DeFi movement and part of what we see with Web3 is actually making these much more accessible, making things, whether these alternative assets were illiquid or whether the marketplaces for them were a bit more opaque in the past, they're becoming more transparent. I mean, I was going to touch on later, but maybe it makes sense to now. The Constitution DAO is a great example, where these decentralized autonomous organizations, they formed this to try and buy an original copy of the US Constitution, right? Which seems crazy, but they very nearly did it, right? They raised, I think it was around 48 million dollars in Ethereum, and they very nearly managed to buy it. So it shows that there was no way for an average person to get anywhere near having only a piece of the Constitution before that. And with these new protocols, with this kind of way of collecting money together, using Web3, they very nearly managed it. So it's very interesting, I think.
What? I'm taken aback by that. You can sell they're selling the Constitution? I don't understand. That's actually
You
a
must have
thing.
you must have been living under your grok rock, unfortunately. Yeah, this happened at least maybe a couple of years ago now, where there was an original copy of the Constitution, because I think maybe there were a few copies made, being sold in a Sotheby's auction, and they created this DAO with the sole purpose to buy that with this collection. And yeah, $47 million in ETH were raised, and they were just outbid by someone else. But it's incredible to think that much money could be raised, with any individual person just putting in their 5 pence, basically.
God, I imagine like America would be like an outrage if the Constitution had been bought by this DAO. Okay, so the next stage, back to the podcast, I guess. Financial products here. I think these are things that most people will understand. An easy one, banking products. That's a kind of quite everyday one that we all interact with. We have savings accounts, pretty low risk, low return. Everyone kind of has done this. You get a small interest rate potentially, which is determined by the government, and that is actually it's actually not determined by the government necessarily. It's a means for governments and banks to regulate things like inflation, right? If I up the interest rate, it encourages people to save, spend less. Maybe I can decrease inflation by doing that. And the other way around also works, where if I have a low interest rate, it encourages people to invest in stocks, trades, all this kind of stuff. The other one that I think people are quite familiar with is checkings accounts. These are day-to-day transactions, typically, like pretty well understood, I think.
Yeah, exactly. So you're kind of the first tranche of banking or financial products is what we would, as we said, we interact with banks, right? And whenever I hear the term financial products, I kind of think, oh, that sounds weird. Like what is a financial product? It's just money, right? But we do use them in our day-to-day lives. A savings account with even if it's a low rate of return, it's still a product. You're still putting in your money with expectation of return, as we kind of said, that kind of thing. Then if you move away to the kind of more complex things, and now we're kind of talking about, again, not just what the institutions are, but what do they do? Then you have your investment products. So this is any way you'd invest in one of those asset classes that we mentioned, whether that be stocks and shares. So like a consumer, typically you might know of something like Robinhood, right? As a classic trading firm. Well, there's lots of these small kind of mobile apps you can now just very easily, surprisingly easily, just sign up and start buying stocks in. You might also have your ISAs as well, your ISA accounts. So something like Help to Buy ISA in the UK, where you're putting in money. Again, some government influence there, because you get a little bit more money from the government if you put it in to buy a house, that kind of thing. So it's the kind of thing that most people, even if you don't think of yourself as an investor, you may well have been involved in an investment product like that as well. And then obviously, as we mentioned, your hedge funds, private equity, all these other firms will have different types of investment products they are using or offering as well.
Yeah, and the big sexy one that we spoke about a few weeks ago was the BlackRock ETF, which is going to be an investment product for people to, put their fiat in, and BlackRock will invest in Bitcoin potentially, assuming that gets approved. Let's see what happens. So that's another example of that, and that's kind of another way in which DeFi is moving into TradFi, and there's kind of this combination or integration of the two, which is quite exciting. We've got insurance products. Doesn't everyone love talking about insurance products, like life insurance, health insurance, property? But this is big business as well. There's like so much value to be derived from that. Insurance makes so much money. I can't remember. I had a fact somewhere. It's like hundreds of billions a year through insurance, just premiums and things like this. It's absolutely mental.
Yeah, it's I don't want to spend long talking about it because it bores me to death, but it is huge business, right? And you have structured products in insurance as well. You have things like reinsurance on top of insurance, that kind of stuff. So again, very big business, and in some cases, obviously, it's also mandated, right? So most of us, if you're driving a car in the UK, you will have had to buy an insurance product, your car insurance, or typically you'll buy a travel insurance if you go abroad as well. Obviously, not mandatory in that case, but it's something that you will have touched that as a financial product in your life as well. And then kind of one of the other bigger, more interesting, but much scarier again, types of product is then your derivatives, right? And this is effectively anywhere you have a product that is not itself the underlying asset, but derives value from an underlying asset. So this is, it's effectively betting on future price or movements of an asset without holding it directly.
Yeah, it's like how did I hear it described once? It's like they're like bets, like you say, on how the price of something will change in the future. It's like imagine guessing like the score of a football game and placing a bet on it, but you relaying that to underlying assets. Exactly. Quite a complicated thing, and it's a bit abstract.
Yeah, but also I've seen, quite common in the UK is there's something called the share save scheme, whereby if you're a company that's publicly traded, then you can effectively, as an employee, you can put your money into this scheme. You take away a certain percentage of your salary each month, and it gives you an option. So that, again, an option is one of these futures contracts, these derivative contracts. It gives you the option to buy the company's shares, so the company you work for, at a big discount in the future. So it says, okay, it's going to be up to 20% discount on the price. You put in your money now for, I'd say, 2 or 3 years. And then at that date, in 2 or 3 years' time, then you have the option to buy the company stock at the originally agreed price. So this is what it means by giving you the option to buy at a certain price. And again, you're hoping that the company stock has gone up because you've been a productive worker in that time. And that's kind of a nice example, because it shows where financial products can have I think a strong benefit, not just for the company, because it incentivizes people to stay at the company, right? To get to see that 2 or 3 year period through. But it also incentivizes you as an employee to have skin in the game, right? Because you think, well, my investment in this product is going to be worth much more if we are successful in 2 or 3 years' time. So it's a nice example, I think, that is less demeaning of the financial industry.
Okay, and some other big concepts that we really need to talk about, because these become extremely relevant when we're going to talk about DeFi in the next episode. The first one is market making, and as the name suggests, this is how you make a market, and it involves like continuously buying and selling all these wonderful financial instruments that we've been speaking about for the last half an hour to provide liquidity to the market, typically done by big institutes like Goldman Sachs, JP Morgan, New York Stock Exchange, all these kind of things. And you kind of, like I say, you can kind of think of this as like a store that always has what you want to buy and is willing to always buy what you want to sell. And they make sure there's always a product available for customers. So you have this kind of guarantee of service that is offered, and that promotes a healthy economy, right?
Yeah, exactly. And part of why there are so many financial products is, because there is a market for them, and then also an incentive to make the market. And and one way I think about this is when you fire up your Robinhood app and you go click, I want to buy shares of Apple, right? Because you think it's going to keep going up, or Tesla or something, then you need someone to sell you a share, right? That's the market. That how you make that market, how you make that happen. A lot of it is typically based on something called an order book, where people are willing to sell, people are willing to buy, and then your market maker is effectively, matching you up if it's an exchange, or is acting as your counterparty. So is willing to sell it directly to you. So again, you need some kind of, whether peer-to-peer is possible, and that's what we said with the OTC, but typically you have some intermediary in the middle who's there to make that market for you.
Yeah, and I think this is like, when I kind of think of how this is actually beneficial, it's like with your Yu-Gi-Oh cards, for example, you try and sell an alternative collectible. It's hard, right? You put it up on eBay, you kind of post it on forums, you have no one to sell it, and that's a big issue. But that was also the case with Bitcoin in the early days. When you're trying to buy Bitcoin, like, it took so long to actually get it from someone who was willing to sell it, and now it's like instant, which is, well, I guess exciting, right? And kind of, it bodes well for the future and shows how much importance there are on all these kind of DeFi applications.
Yeah, exactly. And then kind of highly related to market making is this idea of liquidity. And we touched on this before, but one of the big features of any given market is how liquid it is. So how easily can you buy and sell? How much is there? How much availability is there of the asset that you want to buy or sell in the market? Because if no one's willing to sell, you have a highly illiquid asset. Or if no one is able to sell, I should probably say, then you have a highly illiquid asset. So they're intrinsically related to market making, and having more market makers, better funded market makers, will typically make your asset more liquid. But it's a huge topic in DeFi, right? And Web3 assets in general, because sometimes they're not liquid. But as we'll come on to, I guess, in the next episode, how you make that markets is becoming much more automated, right? And you have these very clever new ways of doing it in the Web3 world.
Yeah, so liquidity is how easily you can turn something into cash, right? If you can sell it quickly without the price dropping much, then it's considered very liquid, and that's very important for businesses and all this kind of stuff, right?
Yeah, but I would say not just cash, right? Because when we talk about, I think that's like the very traditional interpretation of liquidity. Yeah, is how can I liquidate my asset into something that I can pay my debts in to the government, pay my taxes in. But in general, now we talk about liquidity as how easily can I swap one asset for another, right? That's kind of typically what it means. Because as we'll see in Web3, liquidity is often referring to how do I swap crypto X with crypto Y? That's a big aspect.
Yeah, I think that makes sense to me actually. And then the next thing that we have is counterparty risk. And counterparty risk is like the chance that a person or a company you're doing like a financial deal with might not be able to hold up their end of the bargain, right? Like an example of this is not paying back the money that they owe you or not delivering a product you bought. And I think this is really important to understand because you typically have, when you're interacting with big enterprises in traditional ways, you have a way of recourse. If I sign a contract, if you don't pay back your mortgage, then the bank will take back your house and things like that. And recourse is very important. But this has been a bit of an issue, maybe with say things like Bitcoin, because of like the things we talk about, immutability. Once Bitcoin's there, how do you get it back, and like how do you actually do that on the blockchain? You tend to do it at the exchange level, and I think this is a very important thing because quite complicated to instill this in, say, smart contracts that we'll talk about in the next episode, because like the reasons that you maybe don't pay back a loan can be very convoluted. It's not just I didn't pay my loan on this day, so then you take all the asset back. There could be like very actual reasonable reasons why you didn't pay it back, like say the server went down or the blockchain had a delay or you were put in the hospital with an accident. So it's not as black and white as maybe people tend to think it is. And maybe we always will need some human element or some trusted intermediary to actually oversee and control these things in a certain way. But this is something I think we'll speak about in a lot more detail when we talk about smart contracts in the next episode.
Yeah, and I would only add to that, your counterparty risk can take many different forms, right? Because your counterparty for any given financial product might be a different one. The risk associated might be, as you said, for a different reason. It might be reasonable in some cases. It's why you're willing to give your money to the bank and let them reinvest it on your behalf. You have this idea of fractional reserve banking. They don't keep all the assets there all the time, and then in bad cases you can have a run on the bank. But one good example, even for the most basic financial product, which is your checking account, like you said, right, as a banking product. Recently on Black Friday, if you're an HSBC customer, you couldn't really access and transfer your funds because the app was down, right, during Black Friday. So that's an example of your counterparty, effectively your bank as the person providing you the service of using your money, failing you in that case. It was only for a few hours, but it does go to show that this can apply in very, very different circumstances with varying degrees of impact.
Yeah, so Jack Davis, the biggest whale of Bitcoin, couldn't actually sell any of his assets when he needed to. It's painful to see. Okay, so we talked a lot about TradFi, and the question is, why are we talking about TradFi? This is a Web3 podcast, right? And I think we've hinted at it throughout, but all the challenges, the complexities, and elements that we're speaking about here are opportunities for Web3 and opportunities for the DeFi companies that we're going to speak about in the next episode or even next two episodes. Like we kind of said that it's there's a lot of inefficiencies, there's a lot of intermediaries, probably because of the complexities and the information asymmetry that they want. And like I said, this is a real opportunity for DeFi application, and the real fundamental philosophy of DeFi is to shift the trust paradigm from centralized entities and unnecessary intermediaries more and more towards technology. And it's not to remove all intermediaries. I think that's ridiculous. And I think there always will be some need for an intermediary in some form, even if it's just a low reliance on them. But it's to create more transparency and more trust and more efficiency by moving that trust and dependency from those intermediaries to technology, and in a lot of cases to blockchain and smart contracts and all these wonderful and weird technologies that we'll talk about.
Yeah, I think that's very exactly the philosophy of DeFi is minimizing the amount of intermediaries you have, the trust involved, mitigating counterparty risk wherever possible, and it's a very alluring proposition. I think in some cases you could be arguing that it's amplifying some of these risks, and we'll get into the detail. I think in the next episode there have been some significant failings in DeFi, but there's also some real innovation as well that we'll talk about and go into the specifics of DeFi. But yeah, it was definitely, I think, necessary to lay out the foundations of TradFi. What is the problem? What is the aim or the perceived problem that DeFi is trying to solve? With how you provide these financial products, how you create new types of asset classes, how you let them interact and things, and which parties provide those services and products for you.
I think like what I would say is it's people kind of think about it, and the conversations I've seen is that it's DeFi is going to replace TradFi, and it's this binary thing where there'll be no TradFi and there'll just be DeFi. And it's like that's ridiculous. Like, that's never going to be the case. Like, we're already seeing the terminology and we're using it ourselves, like Web 2.5, and seeing how these big TradFi entities who have a monopoly in a lot of ways on the financial sector are moving more and more into DeFi. It's not going to be like, overnight HSBC is going to move to a completely decentralized platform, or currencies will overnight move to CBDC or Bitcoin or whatever it is. But we're seeing the slow transition for, and kind of little cases, little prototypes, little test cases being developed around the world. Like a lot of central banks looking into CBDCs. That's an initial kind of move into the DeFi space in a lot of ways. But I mean, there's a lot of benefits to that. And it's great to see that, say, people like BlackRock and companies like BlackRock are seeing the value for investors, even if it's just value for them. They're seeing there's an investment opportunity there. And there's opportunity. That's what I want to emphasize, big opportunity. But there's also a lot of friction, right? Well, we've already mentioned like some throughout this, like the American SEC versus Bitcoin versus Ethereum. Like what is security? What is commodity? Like, it's these technologies that are coming into these, TradFi ecosystems, and people don't have a clue how to define them or how they fit into traditional kind of definitions. And even we've said it's like very abstract and difficult to actually define. But people need this. Like, people need this kind of this trust, this confidence, and this regulatory kind of certainty to move strongly into these spaces. And then we've also seen a lot of like lawsuits. Binance have recently been really screwed over in America, FTX obviously, and I think this friction is also a really interesting kind of point or area to comment on as well.
Yeah, I think FTX is the really interesting one there, because it was the first time that the TradFi world really properly accepted and bought into the DeFi world and the Web3 world, and it ended pretty badly, obviously. And it shows the same problems of traditional finance can creep in: the information asymmetry, the kind of underhanded operations of the companies in Web3 in some cases. So, but it also shows that the demand was there, right? It shows that, if all these big traditional finance companies could see the value in the proposition of DeFi in general, if FTX had operated as a good company, really, we'd all be hunky-dory right now. It was very much a human failing by the looks of things, and not necessarily a technology failing. But I think it encapsulates the fact that there is demand for what DeFi is offering, and we can learn from its mistakes. As you said, all these different things that have happened. We'll cover some of these kind of explicit examples of those failings in the coming episodes. But yeah, I think maybe for now we should leave it there and say, that is a crash course, a 101 into in the TradFi world, and hopefully should arm us with what we need to talk about DeFi and the specifics of it in the next few episodes. So yeah, next time we should take a closer look at some of the DeFi protocols specifically, and some of the projects we've mentioned, things like Uniswap as well. We kind of very briefly touched on to understand how they work, but also some of the risks and concerns associated with them. But for now, Alec, I think we'll say thank you for listening, wherever you may be. Join us next time to untangle a little more of Web3.
Thanks for tuning in to another episode of Untangling Web3, produced by Emma Camilleri.
Don't forget to send us your thoughts, questions, and comments on social media, and be sure to follow us on your favorite podcast provider to catch the next episode. See you next time to untangle a little bit more of Web3.
The views we express here are our own and do not reflect the views of our employers.